Have you ever wondered what it actually feels like to live through a massive market meltdown? Well, today we're going to take a journey through 100 years of financial panic, all the way from the roaring 20s to today. So, let's dive right in.
I mean, just think about that for a second. This isn't just some dramatic line from a movie. For millions of real people, this has been a terrifying reality. It gets right to the heart of what a market crash actually is. A sudden, gut-wrenching reversal of fortune that can literally change your life in a matter of hours.
Okay, look at this number. -89%. This is the number that really started it all. After the big crash of 1929, the entire U.S. stock market lost almost 90% of its value. This wasn't just a bad day or a bad year, it was a complete collapse. It was so bad it took a full quarter of a century for the market to even get back to where it started.
All right, so we've got to start with the big one, right? The 1929 crash, the one that kicked off the Great Depression and pretty much defined a whole generation.
So how did this even happen? Well, the 1920s had this perfect recipe for total disaster. First, you had people buying stocks on margin, which is just a fancy way of saying with borrowed money. You could put down just 10 cents on the dollar. Second, everyone and their brother was speculating, convinced they were a stock-picking genius. And the third, and maybe scariest ingredient, the banks were completely unregulated, basically gambling with their customers' life savings. The whole system was a ticking time bomb.
In the aftermath, it was just brutal. A quarter of the entire country was unemployed. Millions of families watched their savings completely disappear overnight. There's even the tragic story of Jesse Livermore, a legendary trader who actually made $100 million by betting against the market. But even he eventually lost it all and, tragically, took his own life.
Okay, so as we move into the middle of the 20th century, you're going to see the story starts to change a bit. The causes of these crashes weren't just about wild speculation anymore. Now the government itself and its policies became a huge trigger for market panic.
Just take a look at these three distinct crashes. In 1937, you have the Roosevelt recession. The government tried to tighten the money supply a bit too fast, and boom, the market gets cut almost in half. Then in '62, you have the Kennedy slide. The president gets into a very public fight with U.S. Steel, and the market tanks 22%. And of course, in 1973, OPEC turns off the oil spigot, prices go through the roof, and boom, another massive crash.
But here's the thing about a panic. There are always winners, and there are always losers. A young investor named Warren Buffett started buying up stocks cheap during that Kennedy slide, following his own advice to be greedy when others are fearful. And hey, during the '73 oil shock, McDonald's launched the Egg McMuffin to appeal to families on a tight budget. On the flip side, you had these so-called sure things, beloved stocks like Polaroid that got absolutely crushed, losing 91% of its value. It just proves that nothing is ever a sure thing.
All right, now we're entering a whole new era. Because in the late 20th century, a new and powerful player enters the game, the computer. And with it came unbelievable speed, automation, and a whole new kind of chaos.
And this all came to a head on Black Monday in 1987. This was really the first true computer-driven crash. The main culprit? A new invention called portfolio insurance. Now, it sounded smart. It was just an algorithm designed to automatically sell stocks if the market started to fall, to limit your losses. The problem was, when everyone's computer started selling at the exact same time, it created a vicious feedback loop. It was like a digital stampede with no off switch.
The result? A mind-boggling 22.6% drop in a single day. To put that in perspective, that's double the worst day of the 1929 crash. But, some people saw it coming. A hedge fund manager named Paul Tudor Jones had studied the patterns from 1929, bet that the market would fall, and walked away with a cool $100 million.
So if 1987 was a digital waterfall, then 2010 was like a digital lightning strike. We're talking about the flash crash. In the span of about 30 minutes, the market went into a complete freefall, and then just snapped right back. The high-speed trading bots just went haywire. For a few wild moments, huge blue-chip companies were trading for literally a penny a share.
So of course, everyone was freaking out. Was this a foreign government? A sophisticated terror plot? Nope. After years of investigation, they found the culprit. It was a single trader, Navinder Singh Sarao, working from his parents' house in London. A guy in his pajamas figured out how to spook the entire global market. It was a terrifying wake-up call for just how fragile our modern automated system had become.
And that brings us to our most recent chapter, what you might call the age of epic bubbles. And here we kind of come full circle. The crashes aren't caused by new tech, they're caused by good old-fashioned human greed and hype, just amplified on a massive global scale.
This quote, this real exchange, it basically says it all. This was the dot-com bubble. In the late 90s, you didn't need a business plan. You didn't need profits. All you needed was a .com in your name, and investors would literally throw money at you. It was pure insanity.
And there is no better poster child for this madness than Pets.com. Famous for its sock puppet mascot, right? The company raised over $80 million while losing money on every single thing it sold. It was bankrupt in less than a year. Meanwhile, you had Warren Buffett on the sidelines. People were ridiculing him, calling him a dinosaur for avoiding tech stocks. But when it all came crashing down, his simple, old-school logic, "I don't invest in what I don't understand," was totally vindicated.
And when that bubble finally popped, the sheer scale of the wealth destruction was just staggering. The Nasdaq index, which was full of all these tech darlings, collapsed by nearly 80%. In total, $5 trillion of market value just vanished.
And just as the world started to recover from that, an even bigger bubble burst. 2008, the global financial crisis. At its core, it was simple. Banks were giving out home loans to people who they knew couldn't afford them. Then they bundled all these risky loans together and sold them off as safe investments. It was a giant house of cards. And when it finally came down, it took 158-year-old giants like Lehman Brothers down with it.
But again, a few people saw it coming. Check out this incredible number. That's the return Michael Burry's fund made. He was one of the very few who realized the entire housing market was a sham and bet heavily against it. While the rest of the world's wealth was basically cut in half, his investors got ridiculously rich.
And that leads us to maybe the strangest crash of them all, the COVID crash of 2020. This was the fastest crash in history. The market went from an all-time high to being down 34% in just 33 days. But then, thanks to a fire hose of government stimulus money, it staged the fastest recovery ever too, hitting a new all-time high in less than 5 months. Absolutely wild.
This whole period was just defined by these incredible stories. You had this billionaire hedge fund manager, Bill Ackman, go on TV, his voice cracking, emotionally warning everyone that hell is coming for the economy. What he didn't mention was that he had privately placed a massive bet that the market would fall, a bet that turned $27 million into $2.6 billion.
So, after a whole century of these crashes, what have we actually learned? Well, let's look forward for a second and just imagine a hypothetical scenario to see how these same old patterns of fear might play out next time.
So here's a totally plausible trigger. A trade war. A political decision about tariffs sparks retaliation, and that creates massive uncertainty. That uncertainty leads to market panic, and suddenly we're on the brink of another recession. You see how it works? The names change, the technologies change, but the core driver, good old-fashioned fear, is always the same.
And really, that brings us to the ultimate takeaway from all of this. After 100 years of panic, from margin calls to computer glitches to global pandemics, it's pretty clear that these crashes aren't weird accidents. They're not a bug in the system, they're a recurring feature of it, driven by the timeless human emotions of greed and fear. So the only question that's really left is, what's going to trigger the next one?